Hello and welcome back to another week of your Mortgage Market Movers Weekly, where we are detailing everything that's going on in the macroeconomy to help you make better home buying decisions. This week's 30-year fix is sitting at a 6.69, which is up from last week's 6.66. It does seem like interest rates have been climbing for a little bit, but we may get some relief this week as inflation data is coming out. And as we've been talking about week after week after week, inflation is the key indicator that we want to look at when we are trying to understand what's going on with the interest rates. So we're going to take a look at that, take a look at some of the other data that came out last week and the potential impact that it had on the rates in the market, and anything else that's going to be coming up in the market. So let's head on in to the U.S. 10-year yield. And unfortunately, it looks like this, the yield is just climbing on up there. I mean, let's see. So this is a daily view. So each of these candles represents one day. Rates are not quite at their peak. It looks like they peaked on Friday, the 31st of July. They started a retreat, but they are climbing back up there. Not great for the 30-year fix. Last time they were climbing up this high was back at the beginning of January. So, there's kind of, let's see, if we look at the zone right here, we can think of this as like a little box. Let me see. Can I draw a box on here? I can. This box right here where, let me place this. There you go. So this box right here, the 10-year yield has failed to break really above and out of this box. Back here in 2023, we got up to 5% on the 10-year yield, but since then, it's climbed down, up, down, up, down, up. So, being more optimistic, half cup, half full. Hopefully, once we get somewhere in here, hopefully there can be a catalyst to drop the 10-year yield back down. Sometimes it just happens to be that once these things get low enough, right? So this is going to be inversely correlated with the bond market. So sometimes when the bond market gets low enough, participants are saying that they're willing to buy more into these bonds. So that is our hope, above 5, sustained above 5. That's not going to be pretty for the 30-year fix. Okay. So let's see, like I said, 6.69 on the average 30-year fix. These rates just are climbing up. Fortunately, it looks like people are still purchasing houses, at least anecdotally, here in the Jacksonville, Florida area. But these rates just are not doing great. If we go over to the calendar, like I said, let's start with last week. So last week we had some manufacturing information. It looks like manufacturing was doing well. An expansion here in manufacturing. The prices also were going up. So inflation right here, but they did come down from where they were from the previous read of the manufacturing prices, but still sustained as expansionary. Anything above 50 means that prices are coming up. So not great. There's this loan officer survey I think that we looked at this at one point. That might be something interesting to look at, but I have not looked at it. So when we look at the job information, the big deal was Friday, August 7th. So this was the non-farm employment change. So a loss of 23,000 jobs. The unemployment rate is at 4.1%, which is down slightly from the previous 4.2%. And hourly earnings did not increase month over month. Now, this bad news is actually good news for inflation. This means that growth isn't getting out of hand, right? And growth is one of the contributing factors of inflation. So, this actually, while it's not great for the labor market, if you're trying to look for new employment, this is not great. It's not what you want to see. But as far as the inflation read goes, might not be terrible. And the market reacted to that in a pretty positive way. Let's see, that was Friday. Let me see. Friday, we can see that the 10-year yield, while it climbed, it pressed down. It did come back up slightly, but the 10-year yield reacted to that on Friday as a read that, maybe inflation won't be as bad as assumed. So when we go into this week, we can see we have existing home sales Tuesday at 10 a.m., which that's always important to see. That won't really impact the 10-year yield, but it's just a good data point for us to see. So we are expecting forecast slightly less homes sold than previous, and this is a monthly report, I believe. Monthly. Now the big event is CPI and PPI. So we have core month over month, year over year, and then non-core month over month, year over year. And it looks like there's a forecast for month over month to be a little higher, a little hotter than last because there was no increase in inflation. The CPI report month over month on the core side. So, if this is higher than 0.2, even 0.2 probably won't be great for the 10-year yield, but if this is higher, it definitely won't be great, and we can expect interest rates to respond in the upward direction. If this is below 0.2 or somehow negative, I think that interest rates will really respond, and we should see that 10-year yield coming down. Same with year over year. Really, we want to see a lower number than forecast and previous, and then we can expect the 10-year yield to respond positively. Anything that is larger than 2.5 and 2.6, we can expect a negative response. Same thing on the non-core. Really, we want to be watching this CPI year over year. This is the big thing. The inflation from the consumer side of things, we don't want to see that climb up too high, not only for the 10-year yield, but it's just less buying power that individuals have. And then as it relates to the real estate market, this is just going to put a damper on anyone trying to buy a home, right? So interest rates are going to climb. Your money is less valuable than it was a year ago, and it just makes it harder to get into a home, especially for those on the downward sloping side of the K-shaped economy. So we have the 10-year bond auction. This is going to be pretty important to look at too at 101 Wednesday. And then Thursday we have PPI. So from the producer side of things, this is also important, and this is going to move the needle for the U.S. 10-year yield also. Once we get the PCE, that is kind of the big inflationary data point that the Fed uses to track inflation. Let me see if usually that comes out. Okay. So core PCE, that's going to be the 26. So we will keep an eye on that. Mortgage delinquencies, this is tentative, but if this does come out, that'll be really good to see too. I think I've definitely seen articles saying that there are a good bit of foreclosures in the state of Florida. So let's see if this is more anecdotal or if this is kind of a nationwide thing. We also have core retail sales, which is important, just seeing if people are still out there spending money, and then the consumer sentiment and then inflation expectations. This also can impact the 10-year yield. And, while it might not make as big of a difference as inflation, it does make a difference for sure. Let me see. I really wanted to, I should have prepared beforehand. I wanted to see the predictions for what the market was pricing in, the probabilities for Fed rate cut. Let me see. Fed rate cut. Probability chart. Is this it? I think this is. Okay, cool. Let's see. Okay, so Not great. I mean, the market is pricing in a rate hike for starting in September, and then an additional hike in March of 2027. At one point, this was a pause, and then even I think a cut into 2027. 2027 is definitely a ways away, and this inflation report on Wednesday really could impact these odds. Not that this matters that much, really. Like I said, the Fed, they aren't cutting mortgage interest rates. We want to look at inflation for that. But, this, I don't know. It's not great. It's not really what we want to see. This would be indicative of the Fed expecting inflation to be a problem for longer. So we will see what happens. But that is all I got for you today. If anyone has any questions, comments, concerns, visit us at www.mortgagesbylinda.com or give us a call at 877-TEAM-MBL. Have a great night, everyone. Bye.